No, but I do think rates are going higher, Tom, for a whole host of factors, a higher inflation risk premium, the need at some point for Treasury to raise more supply, and the fact that the market has really only priced about one tightening, and I could see potentially a series of tightening, so yields go higher.
Okay, Paul's got 8 questions. I'm going to get this one in quickly here. If yields go higher, price down, it can be ambiguous, good or bad. Orzag and Posen say you're going to see a higher wage, a higher real wage. Do you buy that optimism, or is it going to be stress?
It's possible. I mean, the AI, the productivity story could translate into much higher wages. The corporate share of income is high, so hopefully at some point that does flow to workers. I was very bullish on the economy and was talking in my prior role of a disinflationary boom, which seemed very reasonable until the Middle East war started, because I think that completely changed the dynamics. So yes, I was bullish on growth in terms of being low and non-inflationary and rates coming down and the Fed easing. All that's kind of thrown by the wayside. In terms of what level of yields crack the system, we don't really know. It's really a liquidity and confidence story. It could be 475 on 10s. It could be 5% on 10s. And there's so many other dynamics at play. And as you're well aware, the narrowness of the market, the equity market, has been a handful of companies. And at some point, that exuberance may itself be stretched. So if the Fed's tightening, financial conditions suddenly tighten, risk appetite changes, and it can unravel quickly.
Joe, in your notes, you say inflation is a problem. I think most of our viewers and listeners would agree with you. How long is it going to be a problem, do you think?
That's a great question. I mean, when's the war going to end, and how quickly can these bottlenecks stop? I mean, the way to think of this is it's a mini COVID. And I think that's what most investors don't understand, which makes me think yields go higher. When I say mini COVID, there's major supply chain disruptions.
Yep.
It's not just energy, it's nitrogen, which relates to fertilizer, different material that go into plastics, other sensitive commodities. And what we learned during COVID is you just can't turn wells off. You just can't shut this on a much, much smaller scale, but you can't just turn the system off and like a light switch, it automatically goes back. And the market is, I don't think, the bond market isn't fully appreciative of that.
Joe LaVorgna, SMBC Nikko Securities, thrilled he could be with us today. And we continue here, I guess, with the arch idea, and you live this at the White House. This is a president who likes joint stimuli all the time. We've got a nominal GDP popping 5% plus, persistently there. We've got, inflation well above the Fed target and all that. Are we just living in a new stimulus-driven milieu and it goes until it goes?
We might, Tom, but if that's the case, then, inflation expectations need to be reset. And you need a higher term structure rates to reflect the environment you just described. So it's either one or the other. Either the economy is going to produce non-inflationary growth, and eventually the Fed can get rates to neutral, or
that worked
we're
out.
in a regime where you've got rising debt to GDP, higher inflation relative to where the Fed's target is, and that would be, and the Fed's not cutting, and that's a higher rate regime.
Do you perceive that model as a 100 basis point shift? Sorry, folks, jargon. A 1 percentage point shift up in the curve, or can it be more 60s-like and be a real shift into pre-Volcker?
Well, in the 60s, it was very, as you know, Tom, it was very gradual. You had cyclical, the floor on inflation saw higher cyclical floors as you move through the 60s into the 70s. Best guess, it's the latter, that it would be like maybe, let's say, 100 basis points repricing. It's a nice round number. But, could it be something longer? It's possible. I mean, in the last couple of years, inflation's running about 75 basis points above the Fed's target. We're going to go higher than that in the next few months. When could it end? Maybe by the fall. We'll see. I mean, I guess the question is, how disinflationary is AI in the short term? May actually be contributing to the problems we have through the data center build out and energy usage. Longer term is probably disinflationary.
We've got a new Fed chairman. Presumably he feels a little pressure to get rates down, but boy, the data doesn't seem to...
Great question, Paul. I'm going to make some news here. Are you interviewing for a position at the Fed?
No, I'm not interviewing for the position at the Fed. No, by the way, and I've gotten to know them. I think they're a bunch of Fed people. That was one cool thing about the job. There's a lot of super talented people there. Kevin Warsh will do a great job. I'm very confident of that. However, I don't see how Kevin's going to make a plausible case for rate cuts.
Yeah,
it's just not there. And if the market continues to price tightening, maybe he just pushes back against the committee that's certainly becoming, at least from the president's, more hawkish. Maybe he pushes back a bit, gets it more center, and then kind of hope for the best. Things maybe unfold in a positive way in the back half of the year. But right now, look at like the prices paid series in the ISMs. The New York Fed's got this global pressure supply index. I'm not sure exactly how they put it together, but the picture certainly shows these supply chain disruptions. That's all pro-inflation in the system.
So, again, is this inflation? I don't know. It just feels stickier to me than just the price of oil. It is sticky.
Well, you could see it if you look at like the San Francisco Fed. They've got the acyclical and cyclical price trends. You look at the Atlanta Fed sticky price index. Yeah, you're seeing it. Absolutely sticky. And by the way, it's been above trend. So, we've been well above, too, in a lot of these components. The super core that the former chair, Jay Powell, likes looking at has been running about 3.5%. Definitely sticky.
So, I mean, there's nothing the Fed can do, right? I mean,
no, there's nothing the Fed can do other than at some point potentially raise rates to try to slow demand. And the problem with raising rates to slow demand to bring inflation back to target, which right now it's probably going to be at least a point, if not a point and a half above target, is generally a recession. The question is, does the Fed want to do that? If the Fed doesn't want to do that, they implicitly change their target. You're going to be in a world then where rates are higher. You're going to have a steeper curve and higher yields.
Real treat for you across this nation and worldwide. Joseph LaVorgna with us today with this SMBC Nikko here with his service to the nation in the first Trump administration. Lots of good work, including serious fixed income chops with Deutsche Bank a number of years ago, also with the American First Policy Institute. What happens to the world you parachuted into after the president?
When you say that, you mean after the midterms?
Is there no? Not. Thank you. I should have made that clear. No, after his term. How does Trumpism carry forward after what you witnessed in the hallways?
The shift. There's been a real shift in the base, Tom. And we look at the polling numbers, and not a lot of very good pollsters. Richard Barris of the Big Data Poll, People's Pundit, actually is an excellent pollster. There's some others out there. And it does show a huge compositional shift in the base, where a lot of independents and others are not identifying with the Trump. New York Times
showed that in the last 24 hours.
And Rich actually made a very good point, and he's sort of, these pollsters is sort of like an inside club. But yes, New York Times Siena poll accurately now reflects what's happening at the moment, because you've got this affordability issue. That is a problem. I'm not sure exactly what happens. I mean, I don't want to say too much, but...
No, I understand that, but I've never said this, Paul. Are out there somewhere, I sound like a Linda Ronstadt song, out there somewhere is the dreaded A word involved, austerity.
No, I don't think we're going to get austerity. Pullback? No, because as you know, neither party wants to actually do anything. And they didn't want to do it when we had Simpson Bowles over a dozen years ago. And right now, unless the bond market or the financial markets put the pressure point on, there isn't going to be a resolution, which comes back to, like you ask about Iran, which to me is a very important, obviously, development. I'm stating the obvious, but what's the pressure point for the president? Is it $6 gasoline prices, $7 gasoline prices? I mean, certainly with the stock market at all-time record highs and rates still relatively low, there isn't really a pressure point for the president necessarily to make a strong decision. So maybe just the option is just waiting and seeing maybe there's some sort of change in leadership somehow by luck or whatever it might be, but you just sit and wait and these things just drag on. But again, in that world, as inflation's moving up, your real funds rate is shrinking, and that by that metric, monetary policy is easing. Equity market's high, credit spreads are tight. I mean, there's a lot of financial stimulus that's offsetting this mildly higher interest rate story we're seeing.
And on the interest rate story, I guess when we think back to the tariffs last year, a lot of folks on Wall Street were saying, boy, 450 on the 10-year put some pressure on the White House, and they kind of started to back away a little bit from some of their initial tariff discussions. But boy, we've blown through that.
Yeah, but the S&P was down 15%.
Yeah.
Let's not forget, S&P was down 15%, and the president quickly pivoted, and the market had a massive rally, and we basically repeated the same thing this past year.
Yep.
But that's the key observation, and I don't need the inside dirt from the White House. It's rude, but the fact is, he is completely beholden to the stock market. Is it just simple? Is it just a simple mechanism where Secretary Besson or Undersecretary LaVorgna walks in on the yellow couch and says, "Hey, stupid, the Dow's down"? Is it just that simple?
No, I think the secretary does a great job giving the president advice, and the president certainly seeks his counsel, and he, I think, is a great voice of reason given his track record. But the secretary is just one person. And the president listens to a bunch of different people. He's got his own instincts and behaves in a way that, he thinks is the right move. But certainly the stock market, Tom, is a dominant driver. And if the stock market were to correct any meaningful amount, that would impact policy, both probably more foreign policy-wise. I'm not sure what we can do domestically at this point, given the midterms are so close.